Thanks everyone for joining us for a Global CIO Symposium co-hosted by VS Partners and Financial Times and ftchinese.com. My name is Vanessa Xu. I'm a CIO of VS Partners. And the symposium is themed paradigm shift, global investment in a restructuring world. And particularly for today's dialogue, we are honored to have a distinguished speaking guest, Mr. Gavin Baker from Atreides Management, to focus on global technology investment, the hype, hope, and reality. A little bit background of Gavin. He is a very well-known TMT investor in the US market. And before he started it, Atreides, which is managing 3.7 billion AUM now in 2019, he was at Fidelity for nearly 2 decades. And during the last 8 years, he was at Fidelity. He was the portfolio manager of a Fidelity OTC fund of $17 billion and awarded numerous industry awards for his fantastic investment track record. And without naming names, Gavin was an investor in many household technology and internet consumer names. So globally as well. And not only he's familiar with US market as a global investor, he also researched in international companies and particularly has familiarity with Chinese technology companies. So we will get into some of that in our dialogue. So Gavin, thank you for being with us.
Thank you, Vanessa, and thank you for the kind introduction, and thank you to you and the FT for having me.
So starting with the hype, hope, and the reality, technology investors have done very well over the last decade, and particularly well since the pandemic, actually. And it's never dull. Technology is naturally appealing to the human nature of curiosity and imagination and emotions. So it draws the most attention, perhaps out of all the sectors of investment, and it's never short of very charismatic and unique characters, icons, and KOLs, and on social media. And so, you know, it has a lot of halo and public attention. But out of those halo and public attention, what are the hypes and possibly false hopes in the technology investment that you, as a long-term investor, would actually caution in order not to step into, in a longer term, a sob story, or if not massive value destruction?
Yeah, we for sure want to avoid sob stories and value destruction. I do think probably the most overhyped technology trend, from my perspective, is 5G. A lot of people are excited about 5G, but I don't really know anyone in the world of technology who is actually excited about 5G. Most of the people who are excited about 5G are either generalists or sometimes journalists, but no one really in the world of technology is super excited about 5G for the simple reason that it does not enable any new applications. And so I sometimes joke that 5G is the fourth G that I've lived through since I lived through the transition to 2.5G, 3G, 4G, and now 5G. And all of those earlier transitions were really important. So 3G really enabled the mobile internet. With 2.5G with Edge, there really was no mobile internet. So 3G enabled the mobile internet, and that was profoundly important and kind of foundational to the world we have been living in ever since the iPhone came out. And the iPhone was really kind of the first mainstream, well thought out, almost application of 3G technology, a browser, a touch interface, things we take for granted. 4G was equally important because it enabled you to stream video, enabled you to stream video, to stream audio. And that, you know, that was really responsible for Spotify, for Netflix, all sorts of new applications Life would have been hard for those applications on just 3G from a just raw data speed perspective. 5G just does not enable anything new and foundational. A lot of people talk about the IoT. 5G doesn't do anything for the IoT that 4G does not do. And so I think 5G is extremely overhyped from my perspective. Now, you have to do it if you're a telecom operator or a handset maker. You have to do it, but it's almost, you have to spend all the CapEx just to stay still competitively.
Right, thanks for that very sobering note, and we'll get to that as well. 5G competition between major economies is a very focal topic in the recent years, particularly given Chinese technology development. We'll get to that in a second, but let's take a step back. You gave a perfect example of something that's very hotly debated and reported in the media space that might not be a best investment theme for a long-term investor. So how do you identify in general what could be a overhyped area, what could be false hopes, and what could be the actual reality that long-term investors, if you wanted to get compound return, to focus on?
Spending, reading a lot, having an open and a curious mind, talking to a lot of people in the technology ecosystem, whether they're founders or early stage venture capitalists. And something I think about a lot when it comes to where ideas come from, there's a very famous venture capitalist called Matt Kohler, who was an early employee at Facebook and then was a partner at Benchmark, which, is, we can debate, but is clearly one of the 2 or 3 best Series A venture capital investors in the world. We can debate whether they're number 1 or number 2, but nobody's really going to debate that. So great venture capitalist, really successful investing track record. And he's a Series A venture capitalist, okay? So he's investing at the earliest stages. And what Matt Kohler said is, my job is not to predict the future. It is simply to notice the present first. And I think being really curious, really observant, and then open-minded to things that are happening in the world that may appear small right now, but can really change the world, can really shake the world, can change the structure of the world. That is what I try to do. I just try to notice the present first, be really curious, really observant, really kind of in the flow, and open-minded.
So we're talking about the paradigm shift in investing in general. A lot of the foundational assumptions, perhaps we all learned over the last 30 years, have been changing, if not already changed. When you say you notice the present to identify the early signs of what's the big trends, what's moving the future. So what do you see those trend movers that's shifting the paradigm or the ground underneath of it?
Yeah, so I think that there are several that are important. There's artificial intelligence. Mark Andreessen, another famous venture capitalist, wrote an article for the Wall Street Journal roughly 10 years ago called "Software is Eating the World," basically making the prediction that the software was going to inexorably become a larger and larger percentage of GDP and become critical to every industry. Every company was going to have to become a software company. I think if you rewrote that editorial today, he would probably say artificial intelligence and blockchain is going to eat the world. So I do think artificial intelligence and blockchain, / cryptocurrencies are very important. The metaverse has been in the news a lot, but I do think that that is a real trend. I'm not sure who is going to usher it in, but I do think in my life, a majority of people will spend a majority of their waking hours in virtual worlds. Today, we call those virtual worlds games. There's a concept, I forget who coined the term, but it's called reality privilege. And so reality privilege means having the privilege of your physical reality be better than your virtual reality. And I think over the next, 50 years through, advances in computing, software, and eventually brain-computer interface technology, for almost everyone on this planet, virtual reality is going to be better than physical reality. And very few people will have that reality privilege where their base physical reality is better than virtual reality. If you think about it, you can, virtual reality, you can be a Chinese emperor, an Egyptian pharaoh, or a Roman emperor, and we can have billions of people living those lives in virtual realities. So I think those three trends are very important, very reasonably well understood. I do think every car is going to be electric. All transportation is going to be autonomous. And autonomy is intimately connected with artificial intelligence. But I also think space is going to be profoundly important. SpaceX, with their Starship rocket, being able to send 55 metric tons into a translunar injection orbit for a variable cost of roughly $2 million. It's really, really going to change the world. I think sometimes it's important, it's important to listen to what people say and have an open mind. And I always think, Jeff Bezos said his vision is eventually the Earth is zoned residential and all industry takes place in space. Now, SpaceX is making that a reality, just because they are so far ahead of everyone else in rocket technology. But I think that is a very exciting vision, and the reality that's going to have a big impact. There is an asteroid called Psyche that has more kind of platinum and gold and nickel on it than we have in the Earth's crust. And so if you pull that asteroid into a stable orbit around Earth, just like a lot of things are going to change as kind of humanity becomes kind of a multi-planetary species, and we spread out across the solar system. And that is probably 100 to 150 year journey. But I do think that has very significant implications, and people are it's almost hard to imagine what will happen once you reduce the cost of going to orbit so dramatically. And that's something I'm very excited about.
Well, you've already mentioned a lot of buzzwords that just excites people. I wrote down on my question list of a space, of a crypto, of a metaverse, and you kind of touched on all of those. But AI and blockchain and rocket sciences and high power computation, all these are the base technologies that enable a very different world. It's one thing to imagine, space travel. It's another thing to find a investment expression. So I'm not sure if you signed up for space travel yet. I'm planning to, but how do you express the, far views and visions on, space and metaverse? Everybody have a, virtual life, and how blockchain changed a lot of industries foundationally. How do you express your view in your actual portfolio?
Well, so it is, from a space perspective, there is SpaceX, right, and then there's really no one else. It's just, there's only one SpaceX. I think that there are many companies within SpaceX. There's Starlink, their
right,
satellite broadband system, and satellite broadband has failed every other time it was tried. Well, what's different with SpaceX is the launch costs are so much lower, and I actually think having really high quality, high speed broadband all over the world is going to be an important kind of driver of the internet. There is still large tracts of the world with billions of people where sure, you might have 3G or low quality 4G service, but you probably couldn't do a high definition Zoom call like this. And I think Starlink is going to change all that. You're going to be able to get cargo from New York to Shanghai in 30 minutes at roughly, maybe slightly more than it costs a 747 to carry that same cargo. So just, that's a whole new, right. Just imagine that. And then you're actually, as a passenger, eventually going to be able to go from New York to Shanghai in 30 minutes. It would have been fun to do a day trip, to Hong Kong and do this in person, Vanessa.
I'd love that. I'm all for it.
Yeah, it's going to be good for coastal cities, just because that's where it's easiest to have a spaceport. But there is really only one SpaceX in space technology, and then you are beginning to see much earlier stage companies that are being funded, to do manufacturing, some of these applications. But in the same way, it was hard when you first saw the iPhone to, imagine Uber and Airbnb and everything that was going to come out of that. I don't think we've yet begun to see kind of the implications of those really low launch costs. And then I do think one of the more exciting things is everybody looks at the world and is like, oh, there's been all this change in the last 5, 7, 8 years. I actually disagree. I think tech has been very static for a while. And the reason for that is there's a couple of things. One, you just had, a continuing shift to the cloud, a continuing shift to SaaS, a continue, you've had SaaS company after SaaS company created going after nichier and nichier verticals. And that's all been exciting. But the way AI works, I think what's the most profound, the most important thing to understand kind of AI and the world, a lot of the world for the next 20 years, is the only thing that matters in AI is scale. And what I mean by that is the quality of your AI is driven almost entirely by the amount of data you use to train the model. So the fundamental underlying equation of AI is for every order of magnitude increase in the amount of data used to train a model, the quality of that AI doubles, okay? So for every 10x increase in the data used to train the model, quality of the AI doubles. And that's profoundly important. There are loads of researchers have there's no end to this. And that has many, many implications. What it means, the strong get stronger. So if you're a big internet company or software company that's collecting a lot of data and is collecting that data in a way that you can analyze it and use it to train models, you get in this really virtuous cycle where, because you're the biggest, you have the most data, you use that to train your models. Those models make your product better. Those attract more users, more engagement for your existing users, more data. And that flywheel's just been spinning and spinning and spinning and spinning. And you've seen that in lots of mega cap tech companies, both in the United States and China. The strong just keep getting stronger. And that's really because of that kind of fundamental law of AI. It also means that the semiconductor intensity of the world is going to go up a lot because you train those models with memory, compute, and then you need a lot of kind of networking and interconnect to move the data between the compute and the memory. And so semiconductors are becoming ever more important because of AI. What's exciting to me about blockchain is the way it interacts with AI. So AI pulls the world towards centralization and the big getting bigger and the strong getting stronger. Blockchain in some ways blows all of that up because blockchain is all about decentralization, theoretically giving users control over their identities. So the interaction between those two, I think, is going to be fascinating to watch. And I do think we're at the early stages of kind of a powerful new blockchain driven cycle. And it's awesome if you're a startup and you do not have to contend with the giant US and Chinese internet companies going after you. You're just competing with other startups. You're not competing with these behemoths.
So fascinating that you went into each of these verticals, and you mentioned the one thing that scale that matters in AI, and it's something that it's non-linear, and it's difficult for naturally human brain to understand something that has an exponential effect to it.
Retail investors have actually done, pretty good this year. I don't know if that's because they understand exponential change, or it's just, I do think a lot of retail investors, something I think about a lot is Peter Lynch.
Or another way to look at it is their behavior is part of the forces that's affecting those exponential changes.
Yeah, well, I think there's two things. One, Peter Lynch, who was a very important kind of influence on me, wrote a book, One Up on Wall Street, where he basically pointed out that, hey, has a consumer, has somebody in the world, you have advantages. If there's a new restaurant and you eat at it and you love it, like, that's important. If there's a new shoe and you like it, if there's a new product and you like it, like, just as a consumer, you understand a lot. And his, signature phrase was, if you love the store, if you love the brand, if you love the restaurant, you'll probably love the stock. And I think a lot of, maybe some of the big winners that maybe were perceived as being driven by retail followed that dynamic. It was consumers who loved the product and then they went and bought the stock. And I think the other dynamic is that Reddit and Twitter and YouTube are letting people collaborate. They're, as a professional investor, it's hard to collaborate with other people. There's all sorts of rules. You need to follow those rules. You can't form a group. What you're seeing is on Reddit, groups of 10s, 20, thousands of investors are kind of collaborating, thinking together, communicating. And that has been a very, very powerful force in the markets this year that I think is a real structural change. Almost the interaction of social media fueled cooperation amongst retail investors, plus all of those retail investors really, I think, generally living by, Peter Lynch's rules around, if you love the product, you'll love the stock. That's been powerful. And I do think it's probably a structural change in kind of in the markets, particularly here in America.
Yeah, that's actually, thank you, Gavin, for, I always respected you as a great investor with this intellectual intensity and depth, but also tremendous amount of humility. As what you just said, even if you are in a market for decades, but still very open-mindedly respecting the new movement in the market structure and consider it potentially as another form of a paradigm shift. And as some of the professional investors call it, the technicals dominated fundamentals this year. And do you see the rise of a large population of millennials in the States that's larger than in terms of the number of people than the baby boomer, and they are the generation that lived through mobile phones and the smart devices, and as you described, social media platforms? Do you see this generation become a force that's shifting the market structure fundamentally?
I don't know if it's millennials. It's like, we've had, there's a new generation that kind of takes over and starts investing, like clockwork for the last, 100 years.
And then they somehow get burned and get old, and then there's that mean reversion effect on the behavior as well.
Yeah, for sure. So I don't think it is healthy. Some of these apps, like everybody who's coming into investing now, most of them grew up playing video games.
Right.
And so, I think some of these apps that gamified investing, they made it very accessible. They made it fun in a new way, but also, investing should not be gamified. Like it's real money, and, you can make money, but you can also lose money. And so I think it's great that some of these new apps brought a lot of investors in. I think kind of the gamification of encouraging really speculative activity, I don't think that was really good for the world. And I think it's always important to be behind things that are good for the world. So whether or not like millennials are, structurally different from a behavioral perspective, time will tell. But, they are much more comfortable in the world of technology. They're much more comfortable with the idea that there can be big change.
As you described, and I recall our, older conversations when we firstly met, you mentioned that you lived through the dotcom bubble burst, and that was your investing lesson. And back then, would you say, or back then, internet was the new thing, and there were a lot of predictions as to how it's gonna, change the earth and change the human life, and then the bubble bursted. Would you compare that couple of years compared to right now, the space, the crypto, the metaverse, and what's the similarities to the early 2000s, and what's the differences?
Yeah, sure. So I think having the first market that I really saw as a professional investor was, was really the NASDAQ go down 80%. It's like I'm very risk averse. I'm very cautious. I'm a pretty valuation conscious investor. I always think about risk first. There's some evidence the first market you see shapes me, but history doesn't repeat that, but it does rhyme. And so I think a couple of things. Like the first thing is, I think it's really important to go back to the year 2000. And if you look at any prediction that was made in the year 2000, they were all conservative. By, let's call it 2012, reality had surpassed the most bullish, 20-year predictions. Like if in the year 2000, you had said that within 12 years, you're going to have this magic smartphone that you can, unlock with your finger, or I forget when Apple brought in Face ID, or your face, and you're going to be able to access every piece of content ever created by the human race. So by 2012, almost anywhere on the world, and that you'd be able to press a button on that and, summon a car, press a button on it, stay in a room at a stranger's house, press a button and speak into it and ask it almost any question. This is, using search via your voice. You could speak into your phone, ask it any question, and it would be able to give you a really, really good answer. You would have been dismissed as absurdly optimistic. So the reality of what happened actually surpassed the most bullish optimistic predictions pretty quickly. So I think it's important, to remember that. And, Bill Gates, Bill Gates, had a phrase: we always overestimate how much, I forget if it was Bill Gates, but somebody smart, somebody like Bill Gates, and maybe Bill was quoting somebody, said, we underestimate the change that can happen. We wildly overestimate the change that can happen in a year and underestimate the change that can happen in 10 years. And that goes to that understanding of compound math. And that was certainly true of the predictions in the bubble. But bringing it back to today's markets, if you looked at the largest tech companies in the bubble, they all traded at extremely inflated multiples of earnings. The exciting stocks back then, were the client server stocks, Dell, EMC, the networking companies like Cisco, Intel, Oracle, Microsoft. They all traded generally at, let's call it, between 50 and 90 times earnings. Okay. Today's giant companies who from like a financial perspective are generally better. Like they generally have higher ROICs. I think you could argue a lot of them have stronger competitive advantages. The growth profiles aren't that different. They're generally trading at, we can, in China, maybe they're trading at 15 to 20 times. In America, they're trading at 20 to 25 times earnings. So just the multiples are much, much lower. And then let's kind of go a layer down to the smaller companies. Back then, there are a lot of money losing businesses that were based on kind of ideas, and some of those ideas were flawed. A lot of, the companies with really rich multiples that are mid-cap companies today are SaaS companies where, like I would say, the meta of investing is always changing. The game within the game. It used, when I first started, people like Mike Mobison were writing about ROIC, and it was such an exciting concept, ROIC and incremental ROIC. And everybody had really focused on ROEs up until then, and the DuPont equation, and breaking it down to what really mattered was I think really exciting. I think another, over the last, it's so funny, like if you go back, only 8 or 9 years, when a company would announce a transition from on-premise to SaaS, the stock would go down. Now we really understand the unit economics of these businesses. And we also, I would say, investors broadly understand they have a degree of control over their P&L that was just unimaginable to companies in the year 2000. Some of these companies, these, mid-cap SaaS companies with really kind of well-established sales motions, they literally have dials at some level that they just set between growth and margin. And it's a conscious choice that they make. And so, that is a big difference. But there are pockets of speculation. I've said kind of publicly many times, almost every EV SPAC, these are silly companies. These are not real companies. Like they have really no hope of competing against kind of the dominant American and worldwide EV incumbent, which is one of the best companies in the world, led by maybe the best CEO. Then you've got the Chinese EV companies who are really good, and then you have the incumbents. The incumbents trying to compete. The OEMs, the American and European and South Korean and Japanese, incumbents that have dominant positions in internal combustion engines, trying to compete in EVs as well. And when, these silly little EV SPACs, they have no hope. Really, they have no hope. And it's really sad that, a lot of people lost a lot of money in kind of that like speculative fervor. And then there were a lot of what I would say kind of science experiments that went public via SPAC. And by the way, there are some great companies that went public via SPAC as well. But I would say that was a big area of speculation. And then, we used to have meme stocks. Now we have meme coins. And I think the one thing, everybody who laughs at meme stocks and meme coins also, a lot of people lost a lot of money in meme stocks and are going to lose a lot of money in meme coins. But I think the other thing is it's important to remember George Soros's theory of reflexivity, which is that markets can change reality.
Right.
And some of the meme stocks from January of this year, their destinies as companies were permanently changed because they were able to issue so much equity at such high prices, kind of recapitalize the company, get rid of all the debt. I mean, it's amazing, So right. These memes, and this is why I think they're dangerous as an investor, and you have to kind of respect them. They can change reality. Now, it's easier to change reality with like, a company that just has too much debt. It becomes a meme stock. You issue a lot of equity. Boom, you have no debt, and you're left with a business. It's a lot harder for like a meme stock to change reality with something like EVs, where it's really hard to do. It's like Anybody can design an EV. Anybody can make a PowerPoint presentation. Anybody can produce 10 prototypes. Producing tens of thousands, hundreds of thousands of EVs, selling them, servicing them, it's really hard.
Right.
And just because one company, has, done it in the West and some Chinese companies have done it, doesn't mean it's easy. It was blood, sweat, tears, eating a lot of glass.
Right. The CEO
really
needs
hard.
to sleep on the floor of the factory for, on the edge of bankruptcy, like Elon Musk has gone through to put it on.
Yeah. I don't think many other CEOs are going to be A, sleeping on the floor of the factory, and then B, doing most jobs in the factory so they understand it. Like, it's just, what happened with the American EV incumbent was really special, really improbable, and was awesome to watch. And then China, like what some of these Chinese EV companies have accomplished, is also very impressive. And these silly little EV SPACs, they have no hope.
Right. Speaking of SPAC as a phenomenon existed for many years, but really took off last year, had its hype and then came down. And you mentioned the SPAC in several interviews, and you also talked about a venture capital investment earlier, or primary investment, and you sort of hybrided private and public together in your fund. And other than getting the longer term view from private research that benefit your public portfolio, and how do you come about this strategy of hybriding your fund? And is that we do notice more and more public equity fund going to private, and a lot of private fund comes to public, and the recent announcement by Sequoia, for example. So this crossover of asset class in technology investment, what does that tell us?
I do think it is the future. I think almost every growth equity firm is going to need a public equity arm. Mm-hmm. And every public equity focused tech investor is going to need a venture and growth equity business. Like, I think almost all tech investors outside of very early stage seed A and B investors are going to be crossover investors and do both public and private. Why is that? I think it creates pretty profound advantages in both spheres. Why did this trend really, really start? Amazon went public at roughly $700 million in market cap. Facebook went public at $40 billion in market cap. So as a public equity only investor, you missed out on $39 billion of value creation. That's a lot. And then as companies have started staying private longer, the analysis you need to do, generally from series C and D and up, mm-hmm. is the same analysis that I was doing in the year 2000 on IPOs. Like, most of these companies, after their Series C, they would have gone public in the 90s and even the early 2000s. So as they stay private longer, they're more and more mature, and the analysis is kind of more familiar. So there's a need to be there if you're a public equity investor, because there's value creation. It's the same analysis that you're used to. And then from the entrepreneur, from the founder of that company's perspective, these crossover firms have a better value proposition to him. And that is because crossover firms are generally evergreen. So they do not need to sell to kind of generate carry. So, if you're the founder of a company and, you're 2 to 3 years away from going public, and you're thinking about who do you want on your cap table, somebody who's going to have to sell in the next 5 to 7 years, or a crossover firm that never needs to sell, can own you for 20 years, and more importantly, can buy you on your IPO, can buy more during the lockup, and then maybe really kind of help you prepare to be a public company. That's a really compelling value proposition for the entrepreneur. So that's kind of why it's happening. But we're early. There's over $3 trillion in private unicorn market cap globally. Crossover firms, they only have 3 to 4% of it. And I think that 3 to 4% is going to well over 50%. Now, this isn't, you need these specialists or seed, Series A, Series B, kind of venture capitalists. And there are some growth equity firms who have really unique operational expertise and can really, really help their portfolio companies in ways that, a crossover investor, broadly speaking, or certainly not me, never could. But if you are a kind of vanilla growth equity firm that is just providing financial capital, I think it's very hard to compete with crossover investors. But there's also big advantages. So when you are underwriting a private company, particularly after like the Series C or D, often the most important risk you need to assess and underwrite is the risk from a mega cap tech company. Is a mega cap tech company going to focus on this small company? Often that's a really critical risk. And I just think as a public equity investor who's living and breathing these public mega cap tech companies, it does maybe give you a little bit of an advantage in underwriting that. And then, from a private company, you do see, when you're thinking about public companies, often a lot of the disruption to public companies is coming from these early stage private companies. So if you're seeing those early stage private companies, you see the disruption coming maybe before public equity only investors do. And then I also think early stage companies are generally trend setters from a technology stack perspective. Definitionally, because they don't have an existing stack of software. They're free to choose the newest and best stuff. And so you often just get a lot of insights into the future of technology from the choices that these early stage private companies are making with their own infrastructure. So I think there's a lot of advantages. And I do think you're going to see kind of crossover firms probably continue to take share. And then just the last thing I would say on this is, there's all this concern about the explosion of value in private markets. And you have to separate value from valuation, right? And what is really happening is that private markets are replacing small and mid-cap public equity technology as an asset class. You're seeing it's increasingly uncommon for a company to go public with a market cap under 10 billion. And so small cap tech and public equities, it's kind of just going away as an asset class over time. So I think value is just shifting from public markets to private markets.
But would you say that the SPAC is a counterforce to that phenomenon? Because younger companies, the smaller, can go, straight to public funding, so that they can be medium, small sized when they access the market, rather than stay private. That could be a phenomenon of the last decade of unconventional monetary policy, that too much money flooded into the private market so that they have the access to the capital that at a very cheap cost.
Well, SPACs for a period of time were a way for kind of silly science experiment companies to raise a lot of money. But I think there were and are a lot of serious companies going public via SPAC.
Right.
And I do think for sure that is one thing anybody as a public market investor, we should celebrate SPACs. It used to be there was only one route to going public, an IPO. Now there's IPOs, there's direct listings, there's SPACs. And I do think the SPAC market is institutionalizing and will stay. And we should all celebrate it being easier to go public, because between private equity and companies staying private for longer, the number of public companies has really shrunk. And that's not good if you're public equity investor, you want more companies to kind of express your ideas, to do research on. So we should celebrate that. I think it remains to be seen if the increasing routes to going public reverse this trend of staying private longer. I don't think that it has yet, but maybe it will.
Mm-hmm.
It's always important to have an open mind, Vanessa.
Right. Time will tell, as you said. I'm mindful of the time, but I never can have enough of your time to have this wonderful conversation. But two more questions. One thing that you mentioned as the risk to younger companies is that they compete directly with the mega cap. And also in an AI world, mega companies with more data has this power of virtuous cycle. But how do you see the regulations worldwide, not just in China, in the US, in EU, of antitrust movement against big platform companies, whether it's going to have any effect on that, or they'll just keep marching on?
Well, like regulation, governments, they can have and will change the destinies of companies. Mm-hmm. I do think it is very, very hard the way antitrust law kind of has worked in America, where you have this consumer welfare standard, to say that these or to find a solid legal course of action against these companies, because generally they're providing product for free, or it's very low cost. And I think in many ways, maybe the most elegant way to regulate them would just be to simply break them up. And I actually think the hard thing is that's probably bullish. Like we broke up, you broke up the old, AT&T, you broke up the old Standard Oil, and immense value creation came out of that. And there's probably a conglomerate discount embedded in a lot of these companies. So I don't think a breakup would be kind of a negative scenario, and it's pretty obvious how you break up most of the companies. Absent a breakup, though, regulation probably would end up being negative. But it's, like these companies, they can hire the world's best lawyers. They all employ a lot of lawyers. They've all been very careful, and they've all been thinking about being sued for antitrust reasons for a long time, and probably carefully and thoughtfully structuring their businesses. So I just think it's not easy in the United States to regulate these businesses. Doesn't mean it won't happen, and it might be very negative, but it's just not easy.
Right. And last question, since VS Partners is based in China, although we invest globally, and then to end the session, I need to bring the conversation back to China a little bit. At the very beginning, you mentioned the 5G perhaps is one of the hypes to watch out for, but it's one of the heated area to talk about the Sino-US technological rivalry. And perhaps one of the paradigm shift that we're facing is that, US has been leading technology innovations for decades, and now is very nationally mindful of a formidable competitor, which is China, being the state sector or private companies coming up on various fronts of technology competition. And there is this worry about value chain disruption, IP isolation, or even decoupling at the more foundational level. So how does this rivalry, which is going to continue, perhaps change your methodology and the framework of analyzing global technology companies, and any impact on how you construct your portfolio, either from opportunity side or from the risk management side?
Yeah, it's a good question. That's probably positive for, the mega cap internet companies in both countries, their equities and their businesses. I would say, though, I think it is important. Really, all of this comes down to semiconductors. And I often feel like there's a lot of misunderstanding. So today, literally anyone in the world can design a leading edge semiconductor. No problem. That is super easy to do. Okay. I mean, it's not easy to do. I couldn't do it, but literally you can do that anywhere. You get some software from Synopsys or Cadence, which are both American companies. You design the chip. Making a leading edge semiconductor is something very, very different. And right now, you can only make those leading edge semiconductors in the United States, Taiwan, South Korea, Japan, and Israel. Nowhere else for true leading edge technology. And to be able to make those leading edge semiconductors, you really need two things. One, you need to buy these big machines from a Dutch company called ASML.
Yeah.
And then these other big machines from American companies called Lam Research, KLA Tencor, and Applied Materials.
Yeah.
And if you can't buy those big machines, today you cannot make a leading edge semiconductor. And on top of that, even if you have those big machines, making a leading edge semiconductor is as much art as science. You could think of, you use these machines in different ways, different steps, and the way you put them together. It's like developing a recipe, and you need years of trial and error to develop a recipe that works. And then once you've had that years of trial and error, you have to keep iterating. And so it's a long way to say you need both these machines and you need time. And so I do think it will be very hard for the US and China to really, 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 really decouple until that changes. And so I'm optimistic that will lead to, rather than this kind of hard decoupling that everyone is worried about. I'm worried about the kind of mutual need will kind of keep the countries closer, because I think that's good for the world.
Right. Thank you so much for that cool-headed closing comment on the need for each other will keep the world hopefully closer and peaceful rather than being divided. And I do imagine that hypersonic travel between Boston and Shanghai at some point, and see you in person. And thank you so much, Gavin, for this wonderful session. And talk to you soon. Have a good one.
Thank you, Vanessa. Thank you, Vanessa. And I look forward, I didn't answer one of your earlier questions. One, I look forward to taking a rocket to see you in Hong Kong sometime in the next 20 years. But I also look forward to seeing a blue sunset on Mars. I hope I die on Mars. That was an earlier question. Was I ever going to leave the Earth? And I hope that I get that privilege. That would be exciting for me. But Vanessa, this is great. Yeah. Thank you. Take care.
Take care. Bye-bye. Bye.